Our last set of ratios has to do with market value. And the two ratios that we are going to calculate are both measures of investor confidence. So the higher the numbers, that means the more confident investors are in that firm and its plans for the future. In other words, the higher the numbers, more investors have more confidence that the firm's stock price will increase in the future. So here's our firm's balance, its income statement, and the other data that we will finally use. So we're going to use things like number of shares, EPS, which stands for earnings per share, as well as the stock price or the market price. So our two market value ratios are the PE ratio, that means price to earnings ratio. Here we're going to take the firm's price, its current price, and divide by earnings per share. So we're given both of those figures for 2020, and we end up with something very close to 12 times. The market to book value ratio, where we take the stock's market price and divide by its book value per share. Well, we aren't given book value per share, so we can calculate it, where we take the firm's equity and divide by the number of shares outstanding. That will give us book value per share, our denominator. So the market to book value per share is 1.56 times. We see that for both of these ratios, we're not anywhere near the industry. And it seems like collectively, all of the ratios for all of the categories told the same story, not near the industry average. 2018, not horrible, but decent. 2019 was a huge mess. 2020, the expectation is if the firm reduces that debt, it will be able to survive and hopefully get things on a positive trajectory. So how are we going to analyze these market value ratios? The PE ratio is how much investors are willing to pay for each dollar of the firm's earnings. The higher the number, the better, the more confidence investors have in the firm. The market to book ratio tells us how much investors are willing to pay for $1 of the firm's book value. Again, the higher the number, the better, the more confidence investors have in the firm and its future. And both of these are high if the expected growth is high and the risk is low.